Welcome back to Next Gen Investing. It's now time for FOMO. And today we are talking Apple, which is down about 3%. Unfortunately, not seeing the favorability I was looking at the top of the morning here. But joining us now to discuss more about some of its supply chain and production right now that's attempting to be reworked alongside the tariff narrative is Karoline Woods, of course, senior markets correspondent for the network. Karoline, walk us through the news we got with Apple, of course, regarding India and some of the reworkings of this company, which frankly, they need to figure out a way to be more efficient when it comes to iPhone 16, which has already been a bit of a disappointment, I think.
Hey there, Jenny. Yes, I was going to talk about Apple's rebound attempts today because shares were higher heading into this hit. But as you said, they've turned lower, down more than 3% right now. And that's due in part to the fact that, as analysts point out, that it's one of the most exposed tech companies to a trade war due to its reliance on China, which we know is facing at least 54% tariffs. Now it sounds like 104% tariffs. So, I mean, very steep, tariffs implemented by the White House, and clearly is weighing on shares once again right now. It's only April 8th, and shares are now down more than 20% in this month alone. So it's been a rough stretch for Apple. Of course, Apple has been trying to diversify away from China for years. It does have production in India, as you said, also Vietnam and Thailand. Those countries also face increased tariffs, but not quite as steep. Even so, though, analysts estimate upwards of 90% of iPhones are produced in China right now. So to that point, you talked about the reporting. There's a Wall Street Journal report that Apple plans to actually send more iPhones to the U.S. from India to offset the cost of those higher tariffs on China. Mentioned that, China, of course, faces steeper tariffs. India's tariffs are about 26% right now. That's just a short-term stopgap, though. That's not a long-term solution, according to this Wall Street Journal report. It's, an attempt to kind of wait and see while Apple tries to get some exemptions from the Trump administration. We know they got an exemption from tariffs in the first Trump administration. No signs that they're going to get one in the second, but we know that that's the hope there. According to the Journal, Apple sees the current situation as too uncertain to upend long-term investments in the supply chain, which is, of course, centered around China. So, this is important because the iPhone makes up 50% of Apple's revenue. And, if prices go up or Apple has to absorb those costs, the higher costs, it certainly could affect Apple's balance sheet. That same there's a Bank of America analyst, actually, that talked about the impact there, because they said Apple was on pace to make about 25 million iPhones in India this year. Normally, about 10 million of those would supply the local Indian market. But this analyst said if Apple were to redirect all of those Indian-made iPhones to the U.S., it could meet about 50% of American demand for the iPhone this year. So would make a dent, but obviously wouldn't cover all of it. That same analyst, though, looks at Apple's sharp sell-off that we're continuing to see today as actually an enhanced buying opportunity for investors to own a high-quality name, and actually points to Apple's PE ratio, forward price-to-earnings ratio of about 21 times, as a key inflection point. It says Apple has typically booked gains in the 12 months after an event that narrows its price-to-earnings ratio. So, it's still looking at this actually as a buying opportunity. Does say it's possible that the risk of tariff escalation with China could pose a more severe threat to Wall Street's consensus estimates for Apple, but points to the fact that they have options to mitigate some of that downside risk, including potentially shifting production to India, increasing prices, changing the pace of product releases, and supply chain efficiencies. So that's India. Now, Apple, of course, has pledged to invest some $500 billion here in the U.S. over the next 4 years. That move was seen as a way to kind of placate President Trump. We'll see if that actually comes to fruition. But Dan Ives was out with a note saying that, it would take 3 years and $30 billion to move even 10% of the supply chain from Asia to the United States, and that would be the end of $1,000 iPhones. He said it would be $3,500 iPhones if they're made in New Jersey or Texas or another state. So it doesn't seem like a very good option here, but we know they are investing here in the U.S. as well.
Yeah, and I think that is such a great point about the cost in which it's going to be to move these operations. I feel like this is something that, I've just been reading some of the commentary, parsing through X, and I feel like that's something that's so massively overlooked. And of course, it's just estimates, but that's such great context for why it's going to be so expensive, even if we see these companies eventually move back to U.S. soil in their entirety, which I just don't know if that will ever happen to that extent. But we so appreciate it, and great insight as always, Karoline Woods, senior markets correspondent for the network. And so now, before we look at a trade, Alex, I do know there was some news we wanted to look at here.
Yeah, and to be honest, so much has changed in Apple that you could still look at similar strategies. We were going to look at a short put vertical, but the prices are so different now. The example wouldn't even really make sense in real time to look at. But I still think a lot of the things we talked about yesterday could make sense, which is low basis, high volatility, risk defined, which could lead you to, if you want a neutral to bullish strategy, a short put vertical. But Press Secretary Leavitt, when speaking to reporters, went through kind of reiterating tariffs expected to go through, no delays. These China tariffs with that additional 50% that was announced today, totaling 104% expected to kick in overnight tonight. And then what I was reading that I think really put a little bit of this pressure on Apple is there was a comment that the president thinks the U.S. has the workforce to make iPhones onshore. So you guys were discussing, Jenny, about whether or not Apple might have carve-outs or exceptions. I think the market's reading through kind of that sentiment and saying, no, there's not going to be exceptions this time. Like, there might be some short-term pain. Apple's lost a third of its value. I don't know if it's the first or the only, but it's lost over $1.2 trillion in market cap. So to my knowledge, it's either one or two. Maybe Microsoft has also lost that much, but it's lost over $1 trillion in market cap. That's historic.
That is historic. And I mean, even the fact that I know we've had a pretty brutal couple of sessions now, I mean, just over the last three, but worse since 2001 illustrates how bad this is even for Apple.
Yeah, no, for sure. And when you look at that, like, why do you invest in Apple? Yes, it's an important company. Yes, it has AI. Yes, it has these growth aspects. But this is seen as a place of stability for portfolios. Down 30% in a year, that's in less than, year to date. Mm-hmm. That's not stability. That's crash.
Yeah. I mean, and gosh, now about 32% off of highs. So well into what would technically be bear territory here as we pulled back obviously over 20% from those peaks, but we're still off lows by 7.5%, maybe end things on a more optimistic note.